So my name is Preston, very excited to be sitting in this chair for the moment, and I thought I would just take a moment and ask for a moment of silence. I know that all of us as housers, whether we're on the board, staff, or guests, that we wear our hearts on our sleeves, that we believe passionately in inclusive and equitable communities. And I think we should take a moment and think about the lives that were lost and the lives that were shattered, and also think about how we are here because we believe in creating opportunities within communities, and it just becomes that much more compelling about why we're here. So before we start, a moment of silence. And with that, I call this meeting to order and ask for a roll call.
Ms. Avila Frias. Mr. Schaefer for Mr. Chung.
Present.
Ms. Gallagher. Ms. Gunn for Dr. Imbasiani.
Here.
Mr. Hunter.
Here.
Ms. Johnson Hall. Ms. Amon for Mr. Metcalf.
Here.
Mr. Prince.
Here.
Ms. Von Koch-Liebert for Secretary Podesta.
Here.
Ms. Sotelo.
Here.
Mr. Russell.
Present.
Mr. Gunning. Mr. Alex. Ms. Wong Hernandez.
Here.
Ms. Patterson.
Here.
We have a quorum.
Great. The minutes of the January 15th, 2018 meeting have been distributed. And if there are no objections to the minutes, that we would like to have them be approved as presented with no objections. Hearing none, we will move on to the chairman comments. I just have one that I would like to make and then turn it over to our director. That I was recently at a gathering of housing authorities that are west of Colorado, and realized that there are 4 housing authorities that have their executive directors who are on the board of the state finance agencies. So I did reach out to Tia to see if there's a way for us, as we're heading to the legislative conference and CSHA's legislative conference, to have a conversation about how do we really use that representation of housing authorities on HFA boards to think about the overlapping and alignment of legislative asks and legislative strategies. So I just wanted to disclose that.
Can you tell us the states?
Oh, sure. It's Julie Bruin and Jody Cole at Colorado Housing Finance Authority, and Lowell Kruger up at the Washington State Housing Finance Commission.
Thank you.
And I believe that there probably are more nationally, but I think Western, it would be great to have some alignment. And with that, I turn it over to you.
So I have one announcement, and you might have seen it in the press yesterday, but we had an upgrade in our general obligation credit rating from A2 positive to A1 positive with an outlook of positive, and our multifamily 3 outlook has changed to positive from stable, and it kept a rating of A1. And so we're very excited about this because this is going to assist us as we go and look for credit facilities or lines of credits. And so to have this positive upgrade from Moody's, we're very excited about. So that's my one announcement that I had to make. And we will coordinate that call
Yes,
on the, we're scheduling it because we're due to go to our legislative conference on March 3rd through 5th. And so where we have priorities that align, we want to make sure that we're talking about those priorities when we go back to our legislative conference.
Great. Moving on to item 4, Mr. Stivers, the Executive Director of the California Tax Credit Allocation Committee, is going to talk about policy initiatives.
Good morning, everybody. Yes, so I was asked to just come and give an update on 2 of the policy initiatives that our committee adopted in December. And there were a number of regulation changes, but I think these two kind of stand out, and they're kind of new and different, and so I just to give an update. The first is that I think we have been concerned for some time that our new construction projects for larger families have been disproportionately located in areas that academics would term sort of low opportunity. And I did present a chart here for you all to sort of look at. And I think this looks at our new construction large family projects over a 13-year period. And it basically, as you will see, we are disproportionately skewed towards those areas of lower opportunity. Actually, this chart could be much more skewed in that if you actually look at it, the highest and high resource categories that are on the left, really those represent, each of those bars represents 20% of the census tracts. The bar on the far right for the highest segregation and poverty neighborhoods is really only 13% of the census tracts. So this chart is actually should be more skewed than it actually comes out in reality. And I think for us that's of concern for two reasons. One, I think a lot of studies have shown that zip code matters. Where kids grow up, what schools they go to, what access they have to jobs, what jobs the parents have access to. It makes a lot of difference in terms of life outcomes. That's been very strongly correlated. And secondly, for us, it's a matter of choice. If you're a low-income family and you're wanting to access affordable rental housing, tax credit projects, right now you have very limited options of what neighborhoods you could even live in. There's quite a few projects in sort of the lower opportunity neighborhoods and very few projects in the higher opportunity neighborhoods. Not everyone wants to move. Not everyone, wants to live in. People may want to live in the neighborhood that they grew up in, but on the other hand, there's not a lot of choice for them. And so, in that regard, one of the big initiatives that we took on this year was to try and create some incentives for locating our large family new construction projects in the areas of higher opportunity. And ultimately, we adopted 3 incentives, and they are, number one, we have in our scoring system a site amenity category. So historically, we've wanted projects to be close to various amenities, schools, parks, shopping centers, or grocery stores in any event, medical facilities, etc. We've looked largely at the quantity of amenities that they are near, more so than we've looked at the quality of those amenities. And so we basically decided that, locating a project in one of these higher opportunity neighborhoods in and of itself is a benefit. We're willing to trade a little bit on the number of things that they're nearby for the quality of things that they are nearby. And so a project could now get about half of the points in that category for being located in a high or highest resource area. Whereas most projects now get all the maximum points, I don't think that this in and of itself will change outcomes, but it will actually make more projects eligible to apply. In some sort of more suburban locations, for example, the amenities may not be quite as close, and this would allow a project in that area to still apply and get maximum points where they otherwise might not have been able to. The second incentive that we created is an increase to our threshold basis limits, which is a very technical term. But think of our threshold basis limits as our benchmark of what we think a project of that sort should cost. That's the best way I can describe it. It is a project-specific number. We start with a county number, and then we have all kinds of adjustments based on, various project-specific factors. But the idea here is that we're sort of recognizing that projects in higher opportunity areas may cost a little bit more. And while we are not willing to say, we'll support an unlimited amount of additional cost, we're willing to support some level of additional cost for those projects. And when we give an increase to this threshold basis limit, it really has 3 impacts on a project. First, it allows them to get a little bit more credit, so help them finance that extra cost. Second is we have a high cost test. We say at some point projects are too expensive, we're not gonna fund them. If we make this adjustment, it actually makes it a little bit easier to pass the test. And third is that it affects the developer fee. We have, 2 years ago, we basically put in a provision that we're going to base a developer's fee on the project's cost structure, so that higher cost projects are going to get lesser developer fee, lower cost projects are going to get a higher developer fee, and it is meant to be a way of keeping developers incentivized to reduce costs where possible. If we use these threshold basis limits in that calculation, and so to the extent that the threshold basis limit is higher, the developer of a project in a high opportunity area can actually receive a little bit higher developer fee than they otherwise would have. So those 2 incentives alone those are 2 incentives that again recognize the higher costs, make it a little bit easier for projects to apply. But the third incentive that we are delaying for 1 year until 2019 is probably the most important, and that is because it's a tiebreaker increase. And as I mentioned, just about every applicant in our pool gets maximum points, so just about every funding decision comes down to the tiebreaker. And if we want to change outcomes, we decided that we have to change the tiebreaker or we're not going to make a difference. And so, again, starting in 2019, a large family new construction project in a high or highest opportunity area will get a tiebreaker benefit. It's a 20% add-on for a kind of non-rural project in the highest opportunity area, a 10% add-on for a non-rural project in a high opportunity area, and then those percentages are cut in half within our rural set-aside where tiebreakers tend to be lower. Those are significant. What we were trying to do was create a significant incentive that was not determinative, is the way I would say it. Where it was going to make a big difference, it was going to be a big incentive for folks, but it wasn't necessarily going to be the one thing that drove all outcomes. So if you think about in our non-rural areas, the set-asides or the tiebreakers that win are probably in the 50 to 75% range. A 20% add-on gets you about a third of the score that you need, but you still have to find the other 2/3 under our traditional means. And so it's big, but doesn't determine outcomes in and of itself. There was public comment during our regulation period that a lot of people thought the incentive may be too big, that it actually might drive too much of our funding to such projects in these higher opportunity areas. Our goal remains has never been to focus exclusively on high opportunity areas. What we're trying to do is get closer to parity, right? We'd like this chart to be balanced. We don't want it to all swing to this other side. And so in that regard, we actually are also going to institute sort of a cap on how much credit we will put into these large family new construction projects in the higher opportunity areas. Again, starting next year when we employ the tiebreaker change, once we get to 30% of the credits for such projects, we will start skipping over the next such projects in line and looking for other projects to fund. We would only come back to the high opportunity projects if we ran out of other projects to fund. We employ these housing type goals, as we call them, in other parts of our competition. We have similar goals for senior housing. We have similar goals for special needs housing. The idea is that at some point you have too much of a good thing and you start moving elsewhere. So that is the first sort of a major initiative that we are taking. I do envision it. We'll see it sort of ramp up over time. We have done projects in the higher opportunity areas over time, so it's not like we have none. We may have a few that are coincidentally going to come in this year because they were in the pipeline already. But as you all well know, it takes years to sort of put a project together, and everyone has been telling us that putting a project together in a high opportunity area is probably more challenging than in other areas oftentimes. So I think the outcomes here we'll probably see over a number of years. But nonetheless, it is our goal that in the next 10-year period we start to see a chart that's a little bit more balanced as we go through. And again, with the idea that the tenants have more choice of where they can live, and that the tenants who are in the developments in the higher opportunity areas, hopefully we'll see better outcomes. I'm happy to take questions on that topic. I can move to the second one, which is completely distinct, but I'm happy to engage in questions or discussion on that before I move on.
Please.
I just wanted to comment. It's not really a question because I think what Mr. Stivers has done in this process is a remarkable balancing act, because we've seen with the 50th anniversary of the Fair Housing Act coming up next month, we're hosting a conference, and so I've been steeping myself in a lot of that history, and it's really compelling what are the inequities over time that we're still addressing, and that what you're trying to address are a lot of the legacies of many, many decades of institutionalized segregation. It's just, it's commendable. The goal is absolutely essential, and the children need to be in places they can thrive. At the same time, I think it underscores, when you look at this chart, a lot of this production is because of redevelopment areas, and that loss of redevelopment is going to help you, I think, bring this bar down simply because there are not resources to build in a lot of these areas. But we do have continued concern about gentrification and being able to build in low opportunity areas that are experiencing gentrification. I think what Mr. Stivers has done has been a remarkable balance between these competing interests, but it really underscores the fact that we still need resources for these communities to rebuild them and make them into high opportunity areas. Housing is but one of those pillars, but it's an important one. So I want to thank you for, I've been a witness and a somewhat participant in those discussions, but it's been a brutal battle, and I commend you for arriving at this place where we are today.
And I would like to give a lot of credit to our partners at HCD. This is really a kind of a joint effort, and actually CalHFA has been instrumental and so very supportive of this effort as we've gone along too. So this is not, well, my board has those members as well. So this is not just a TCAC effort. This is a sort of a broader effort. I think we are just the first to employ it. And ultimately, I think, we all share the concern about segregation and inequality in this country. And while the tax credit, program is just one small piece of the housing market, we felt like we could be part of the solution. So,
Any other comments?
okay.
I'd like to just echo what Stephen talked about. There has been intentional decision-making that's happened over a long period of time that has led to inequity and exclusion. And so looking at this and thinking about it, and as you talked about data and really evaluating, I do want to point out that under the Move to Opportunity studies that there is a need for navigators as part of that process, that as families moved into high resource areas that they tended to move back initially under Move to Opportunity work because they did not have the resources to be able to survive and thrive within the new community. So thinking about how do you help with the navigators? How do you, and I think what we see happening in Minneapolis or Baltimore, that those Move to Opportunity, the programs are really being successful when there's support that's coming along with it, not just having families move into neighborhoods where sometimes they may not be like anyone else, right? And so how do you address that? And I think that that was also under the Move to Opportunity studies. And then the second thing is that I think it is about continuing to look at the data. There's a lot of place-based research that's starting to come out that shows really high outcomes as well. And so I know that I think it's limited resources. So you have to do what you're doing, and I applaud you for that, of thinking about how to prioritize, but to also continue to look at the data as it comes out. And I also should say, you did come to the Valley and talk with us, so I totally appreciate that, what you did on that listening tour.
I will think some more about sort of that navigator concept. I would just add that, luckily our 9% projects all do come with a heavy dose of services. They tend to be sort of tailored to the needs of the project, and so hopefully there's a nice overlap there, but it might be something we want to think more about. And in terms of just even how we do the maps, I didn't really talk on that. We sort of engaged a number of academics to sort of help us figure out how to map opportunity. It is a difficult task. There's no perfect answer to any of these questions. We will continue to sort of look at that as we go forward, and we intend to sort of do at least annual updates of the maps based on new data, but, at some point we think about methodology changes, and particularly in rural areas is one that we're focused on this year, of how do we, rural areas present real challenges in terms of how you do this, and we're going to continue to spend more time on that, but we continue to look at the data, and as the outcomes come in, we always, every once in a while, sort of reevaluate sort of where we're at. Thanks. All right, well, with that, I will move on to the second topic. So, hybrid projects. So what is a hybrid project? So generally, the projects, that come into the 9% tax credit program, it is, we just see one application, and it's all, you're asking for all of our 9% competitive tax credits. A lot of the projects who compete in that 9% program have excess basis. They are not requesting all of the credits that they could, and that's partly for competitive reasons. They get a competitive advantage for reducing their requests and trying to leverage other outside resources. But as a result, all this basis is out there left unused. And I think Virginia actually kind of pioneered this concept of, what if you took that same project and you split it into two components, where one of it remained a 9% project and the other component became a 4% tax credit project, which is non-competitive, right? Those are the ones that use tax-exempt bonds, and the 4% credits are unlimited. You use all that extra basis to generate additional credits that otherwise you wouldn't have at all. There's no limit on them. And then that can actually reduce the amount of 9% credits that you're actually asking for further. So it's a way of stretching out the 9% credits. It's a complicated structure. It adds a lot of confusion, sort of, but the benefit is pretty compelling in that you can fund a much larger project, or you can fund the same size project with a lot less 9% credits and take these kind of free 4% credits that are just sitting on the table. TCAC has been engaged with sort of hybrid projects for about 5 or 6 years. So we've got 2 or 3 of them in San Diego alone. They are high-rise projects that were just too big for us to fund through the 9% program. They would have requested way more credits than we would have ever allowed. So they split them into 2. And in fact, just to give you an example of a project called Celadon, the 9% project is like floors 1 through 9, and the 4% project is floors 10 through 15. And there's like a condo division, whatever. In 2017, we allowed some projects that had already received 9% credits to convert to a hybrid. As you probably recall, when after the election, the tax credit pricing dropped about 15% very quickly because of the prospect of tax reform. A lot of projects that we had already funded all of a sudden had gaps that they couldn't fill. And we said, well, hey, we'll help you fill them by using this extra basis and generating 4% tax credits. Only 2 projects took us up on that because the time window was very short, and again, the complication is fairly big. But going forward, we decided, hey, you know, this benefit could be really good. We could get a lot more units for a lot less 9% credits. Let's try this. Let's try to give an incentive for people to do this. So, starting this year, a project that comes in as a hybrid, that they're going to give us both a 9% application and a 4% application at the same time for what would have otherwise been one project, but has now sort of been, you know, structured into 2. We're going to give them some tiebreaker benefits. The first thing that we're going to do is we're going to count we have a size factor in our tiebreaker. You get a new construction project gets a bump in their tiebreaker for the bigger it is. We're trying to get to cost efficiencies there. And in that size factor, we're going to count all the units that are in your 4% project towards your 9% tiebreaker. So that's an incentive. Number 2 is that we're going to basically count all the public funds. Public funds is a big part of our tiebreaker. Normally, we would just look at the public funds that you have on your 9% project, and that would be how we would score your tiebreaker. In this case, we're going to look at the public funds that you have on your 4% side as well and add that in. And the idea is that if this had been one project, all that public funds would have been in one project. You've had to split it up to sort of make these projects work individually, but we're not going to penalize you for taking some of those public funds that you had and moving them over here to exercise this additional basis and get additional credits. And then thirdly, just we have a part of our tiebreaker calculation is a function of how much credit you're requesting over your project costs. And for purposes of that denominator, the project costs, we're going to kind of look at it over the combined project costs of both projects. So again, you're reducing your 9% credit request for what would have been one project as a whole, and so we're going to look at it that way. Anyway, those tiebreaker benefits are not maybe as big as some of the ones we talked about in the opportunity area, but they are probably big. They're probably in the 6, 7, 10% range possibly, and that's a pretty big incentive in our world. And so we do think we're going to see a number of applications in this regard. There's a number of conditions on it. I mean, the bottom line is that they have to be simultaneous projects. You have to be kind of close to each other and going at the same time. We're not looking for people just to marry 2 totally distinct projects together. 2 is that 4% project has to look like a 9% project is the way we say it. It has to have that deeper targeting. It has to have the services. It has to have the same sustainability. You don't get to lessen your standards just because you're sort of splitting part of the project off. And then third is that you don't get a double developer fee. You get the one developer fee that you would have gotten for doing the one project. So, but anyway, with that, we are, our first applications come in at the end of the month. But I am hearing that we are probably going to see a number of hybrid applications. People seem to be fairly excited by it, and I'm also being told that the 9% credit requests are going down pretty significantly because of this. I mean, and for those projects that are choosing the hybrid, they would have otherwise come in with a much, much higher credit request. That will allow us to fund more projects and more units. So anyway, we're pretty excited about this, but we're just in the preliminary stages. I know it's complicated, but happy to go through it any more you want. But.
Yes.
Right now, the 4% credit pool is not competitive, but what do you see that mix looking like?
Yeah, 2016 was a record year for us. It was actually unsustainable. Our sister agency, CDLAC, allocated like over $6 billion of bonds, and their annual allocation was only about $4 billion. We had a lot of carryover from previous years, but obviously that's not sustainable. Because of tax reform, things plummeted in 2017. We thought we might get competitive at the end of 2017, but then when tax pricing brought, our 4% production went down by 50% last year. So we had instead of using up all the carryover and all last year's allocation, we still have about $1 billion billion in bond allocation left to roll over to 2018. So we think in 2018 we're going to be fine. We think the production levels on the bond and 4% projects will probably be similar to 2017. If they start to tick up, that would be great. And I mean, at some point, we're not too far away from getting competitive. We don't have a lot of carryover left. $1 billion is a good amount, but it's not huge. So at some point, we could get competitive. And I think what CDLAC's plan is to spend this year preparing just to make sure the regulations and systems are in place that if at some point we go competitive, we're ready to do that. But at this point, it's too early to tell. It definitely won't happen this year.
Dalila, sure.
Thank you, Mark, for the presentation.
Yeah.
It's very helpful. Did you look at this analysis relative to the 4% LIHTC?
We have not. We have not. And I think, given more time, we would like to go back and sort of map those projects as well. Obviously, the 4%, because we're undersubscribed and over the counter, we don't really, there's not really much of a competitive, we're not choosing between projects. Basically, we take everything that comes. I would also say that the 4% program is about 70% rehab. So when we've done this analysis, we really looked at new construction, because we always are going to try and keep the things we have in place, right?
Right.
But I am also interested in that analysis. It just was sort of prioritized with the competitive program.
Great.
Next
Thank
step.
you. Yeah.
Thank you.
Any other questions? Mr. Stivers, we're letting you off
Thank you. Good.
easy.
Yeah, yeah.
This group usually
Well, you
is
have a lot of
pretty
things on your
tough.
agenda, so
I think they're saving all of the questions for the staff on the
Good.
projects coming up. And
Thanks,
I know
Steve.
that what's going to be asked 4 times is the proposal within a high opportunity or high resource area. So you've already asked our first question for the staff. But thank you very
Good.
much for joining us today.
Thank you.
Thank you, Mark.
And with that, we're going to start with the final loan commitments for 4 different projects.
Good morning, Mr. Chairman, members of the board. It's Michael Carroll, and I have Steve Lyerly with me, loan officer for our first presentation. We have 4 loans to discuss with you today, and I will turn it over to Mr. Lyerly for this first project.
The project I'm bringing before you today is Chateau Lafayette. It's a 67-unit senior project located in Lafayette, California. It's been in our portfolio since about 1978. We participated in the construction financing on it, and we've held it all that time. It currently operates under a Section 8 HAT contract that we administer. It's been given a renewed contract with a markup to market for 20 years, and which will be administered by HUD in San Francisco. The property is 67 units. It's the loan amount is $12,750,000. The equity out is in the neighborhood of $11 million. The property is in excellent condition. It really has, it had no significant needs to be, brought up to date. It's been very well managed and maintained. The owners is Lafayette Senior Housing Associates. It's the only property they own. They're a, nonprofit, public benefit, or whatever you call it, corporation. And they'd like to use the equity out of this to buy an additional property and increase their holdings and their impact in the region. They're in eastern Contra Costa County. The metrics on the loan is, as currently underwritten, about 68% loan to value with a 1.15 debt coverage ratio, meets all of our underwriting requirements. And they're going to do some voluntary work with a portion of the equity out, about $1.5 million. It's going to go to do some things. They'd like to replace the siding. It's currently just a plywood rough-sawn siding. Soaks up a lot of paint, subject to a lot more water intrusion and absorption. They're going to go to a cementatious material like a hardy board, something like that. Also kind of upgrade the look, change the elevations, change the trim. There's some walkways between the buildings that makes them almost all elevator assisted on the second floors. And, there's some structural members there and some warping and some, hidden damage that we'd like to see replaced. There are also single pane windows based on when they were built. So all the windows are going to be replaced with dual pane windows. And I think that's really the most significant areas of the updating that they would like to do. This wasn't required of the agency. These are things that they'd like to do to increase the appearance and livability and extend the life expectancy and for the building more sustainability. We're recommending this project. We'd like to keep it in the CalHFA portfolio and under our asset management. And that concludes my presentation.
So I'm sure, Emery, you're going to have questions since it's your hometown. And then I know Dalila is going to ask you why are there 4 different interest rates for all different projects, but I'll put those words into her mouth and you can think about that. So is there someone who'd like to have any questions, comments?
I'll start. So on the refinance, so they're gonna reinvest in some renovation, and then what do they plan to do with the rest? They just want the equity out, or?
In my presentation, they're going to purchase another property as their intent.
Is it that purchase, are they planning another affordable housing development, or if they share?
Well, yes, they can, they haven't identified anything, but that's their mission. They're a nonprofit for affordable housing, yes.
Jonathan Hunter. And so at this point, though, this is the only project that group has?
That is true, yes.
Sure, Stephen.
So I have a question about the physical needs assessment. So you've done a rigorous review of that?
Yes.
Okay, because it strikes me that the age of the building, in particular the hydronic heat systems, which date back to if that's correct, what the report says, it's a hydronic heating?
No, it's split heating and cooling. It's, there's a term for it that.
The split systems?
Yeah,
Okay,
yeah, they
okay.
go on the wall.
Okay, now there's a reference
the
to
way it's-
hydronic heating systems in here, and those are notoriously bulky.
Oh,
And
yeah.
I would be
No,
surprised if after 40 years.
there's 2 master boilers, but there's not a hydraulic heat system,
Okay,
no.
okay, the report,
Yes.
yeah.
No, actually, we took it out, but the immediate needs was $1,000. It was for a limb that had broken onto one of the flat roofs that just happened to have happened when we had the CNA or PNA provider was out there. And we've actually had this done by 2 separate companies have done the physical needs analysis for this property. Basically, over the time that this property came in, you'll see the numbers on is 16. So we've been working on it for quite some time, and so we've updated several of the studies over time.
So Steve, if you can check page 11, where Member Russell was referencing the heat systems of the board.
Page 6 here.
Page 11 of the board packet, or page 6 of the staff report.
I followed you, yes. Is this under the property description?
Yes.
There's wall-mounted combination air conditioning and electric heaters, so if you take me down, yeah, I don't know the I'm sorry. I can't respond to that.
Okay.
I don't know what the intention was there or how it got called out in that way.
Okay.
If you look below, it talks about there being wall-mounted combination air conditioning and electric heaters. If I could, we have the property managers here. Are you aware of a hydronic system at all? Yeah,
So is it safe to say that that might be a mistake in the staff report?
that's what I'm claiming. Yes, that's what I'm apologizing for.
Thank you, that's a significant change. The other question I have is about the Phase 1. So you said that there was some trace, that there'll be a second environmental assessment done as part of, prior to closing, is that correct?
No, there was a phase two, there was a phase one.
Okay.
And then there was a follow-up phase two based to upgradient. They found some staining on a slab to a facility that had been a dry cleaner, and there was actually a barrel there that was rusting, and you could see staining on it, and so it was obvious concerns. They felt that there should be a follow-up, and we did do a follow-up on it. We found, we did, a bunch of, drilled some wells, did some sniffing. But the response came back that they did find some, trace chemicals and stuff, but it didn't come to the level that required any further action. The reason we were going forward with a new phase one was that Barcelona Management Associates had done it on behalf of the owners, but the owners weren't listed on it, and we weren't listed on it, and it didn't really provide any circle of protection for either us or the owners, and that's why we're requesting it be redone.
Sure, your turn.
I'd love to hear from the nonprofit developer if they're here, just about their plans of the pipeline and what their mission is and what they would use the $11 million.
Sure. Mike? You mind? If you'd introduce yourself for the record.
My name is Mike Robertson. I am the board vice president. I have been on the board at the Chateau since 2008, so readily familiar with our core objectives. Should we be blessed with this money, we would like to promote affordable housing in the immediate and local communities, communities which I believe are referred to now as high opportunity communities. There is a very definite need for housing stock, and we hope that we can collaborate with other nonprofit organizations such as churches, anybody that might have land available that we can obtain and develop in accordance with the local community's objectives.
Well, along that line, I think that there are a number of single asset nonprofits that were, it seems to me, created in the 70s and 80s. I assume this was in the 70s, maybe?
1978.
78, okay. And so I guess my question following up with Dalila, and I don't know if this is a CalHFA kind of question, but it's really about what are the plans to strengthen the board as you look at doing more growth of your portfolio? Totally appreciate as you're looking at how do you take an asset and reinvest and grow resources for the community, but how do you make sure that the board is prepared for that and is able to handle the increased responsibility and risk?
That's a great question, and that's one of the things that's floated around through my mind. We have an interesting board, and the executive leadership, our president is if you will, a founding board member. She was actively involved in one of the multiple service organizations in the community that created the idea and the funding for this development. So she has been there since 1978, since day one. So she has a very deep connection to the senior community in the not only in the city of Lafayette, but also the surrounding communities of Lafayette and Rinda. I think we need to look at the composition of our board, and if necessary, with all due respect to current board members, make sure that we look towards recruiting to people that have depth. The finances would be managed by an independent professional firm that has significant experience in this scenario. Our current board, well-served, but I think, again, we need to look for a little more depth. So it's certainly something that is very high on the agenda.
And I totally appreciated your comment about looking at high resource areas, but you're a senior provider. I think they're exempt from the high resource areas. So are you thinking about maybe strategically serving different populations? Or are you going to continue to focus on seniors?
Well, the original charter of the organization is very much senior-oriented, so that is going to be, I guess, our primary objective. We want to respect the original intent when the organization was created. The primary goal will be the promotion of affordable housing for seniors. If we can expand the scope beyond that, we certainly will be looking at opportunities.
Certainly with $11 million, you could probably self-finance a project, you know, and not need a 9% allocation, right? Because you can find a project within the area that would meet your needs.
Yeah, one of the biggest challenges for us will be to obtain land. That's why we're hoping that we can partner, if you will, with somebody who, like I say, a church or somebody in that that might already have land available and may wish to, for lack of a better way to put it, donate it to us in accordance with their mission and in accordance with the local community where it's located.
And I don't know if there's a role for CalHFA in helping with strategic planning and board governance and strengthening of these partners that we have, but just throw that out there to think about. I don't know.
I will think about that, sir.
Well, please know that we would be very cooperative and grateful to have any assistance.
Yeah, I mean, I see in my community a lot of organizations created 40 years ago. I think of one that is a faith-based organization, and there are members of that board who've been on the board for 40-plus years. And as they've been talking with the housing authority about as they reposition their asset, my concerns are all about what's going to happen 20 years from now, right? And how do you work on the governance and the strength and the sustainability of that organization? So I think we should be thinking about how do we help the sponsoring organizations. I think that, Dalila, that's what you were asking about, or is it? Or just, you were also
No,
just
no,
talking about the use of the dollars.
Yeah, to me, it's about, you know, again, one of the policy things that I think that we need to look at as a board is how we have been able to perpetuate additional affordable housing as a result of our financing programs, and actually take credit for some of the additional development work that has happened as a result of being able to infuse equity into these markets. So one of the things that, you know, I'd like to do now that the program has had you know, significant amount of projects is really kind of do a report back on what the nonprofits did with the equity, you know, and where they placed it and how it was used and whether it generated additional housing. Because I think that's a great story to tell. You
I
know,
agree.
in the last 6 months, we've infused about $24 million into the marketplaces that we've loaned on. So that's a big deal.
I agree.
So,
So
and I
then-
like working with nonprofits
Mhm.
who are mission-driven, mission-oriented. And I would just encourage you not to necessarily just look at new construction, but maybe look at some, you know, existing, expiring covenants or buildings that need rehab, and maybe look at, you know, seniors that have special needs, you know, that are about to be homeless, or, you know, something of that nature that, you know, that are more unique than just your standard
And that
senior
point is
profile.
well taken, in that the availability of raw land, for instance, is a huge challenge. The need for existing physical plant, it's a whole different scenario. I mean, the ability to come in and rehab something is far more practical than to build something ground up.
Yeah. So you're talking about naturally occurring or preserving of affordable
Naturally
housing?
occurring affordable that you can preserve with a covenant for a longer period of time, you know, as an equity participant in the purchase, or taking motels and redoing them as, you know, permanent supportive housing for seniors that are going to be homeless.
And I love the idea of a hybrid, so if someone's coming in to do a market rate development, if you could do some floors of affordable with it, I think it'd be kind of interesting to see your opportunities and possibilities. So I did want to get back to the interest, but I think that we'll ask the staff about that, the interest rate and the policy conversation on that, but Stephen had a question first, I believe?
It's really a comment, just as I spent a decade on the board of a local community development corporation, which is the kind of organizations you're talking about, and LISC, Local Initiative Support Corporation. I'd really encourage you, if your board members have not attended any of their trainings, their technical support is amazing. They even have pre-development assistance. But for organizations like yours, it's really important. I'm a strong believer in just what you're talking about, recycling these dollars into, as we do this financing, into community development activity and these smaller organizations are typically more on the ground. And so I, you know, commend the work you're doing, and I want to make sure you know that there are resources out there that are very much tailored to the type of work you're doing. And if you don't know LISC, we can talk.
Oh, very, very, very definitely. And to speak to the depth and breadth of the board, it's one thing to be kind of a caretaker of an existing facility where, the typical board meeting and agenda is composed of fairly routine matters. This is no longer a routine matter. And we have an opportunity to put forth a great deal of benevolence into the community. And I think that the composition of our board 6 months from now will be significantly different than it is now. Again, with all due respect to current board members, but we need to find folks that are going to help us move this mission forward and have the depth and, again, breadth to help us do that.
It feels like you're walking in with your eyes wide open, so thank you very much for that. So if I can just, I tried putting the words in Delila's mouth, but I'll just do a better job of it. Can you talk a little bit of, so thank you. I think you can, I'm going to ask something of staff now.
Okay.
So thank you.
Thank you very much for your consideration.
Yeah. Yeah, so it's really with all four. It's a policy, right, I was hoping Michael would come back. So the policy question is really about how do you set interest rates? Why are they all different? And to help us maybe understand the process you go through and as you establish the different interest rates?
Sure. So each of the programs is governed by, outlined in a term sheet. And I think each of the loan packages you have has the appropriate term sheet as an appendix. For the refinance program, the spread over Treasury is lower than our new loans. It's an incentive for the borrower to keep it in our portfolio and for us to do that. So the spread on this one was lower than the other deals you might see in the package. And then there's also the factor of time. Depending on when a loan opportunity came into our pipeline, if we would honor the rate that we quoted with a letter of interest presented to the borrower at that time. So if a deal is more than a year old, it might have a different interest rate than something that came in newer. And we are, about to issue new term sheets, given the a number of factors that are recently occurred. One is our standard federal financing board capital is running out. Basically, it's a pilot program. So we are having to reinvent, go back to new capital sources, probably issuing tax-exempt bonds. So in the coming few days, actually, we will be reissuing new term sheets based on the present circumstances.
Well, so I think that's a great comment that you're bringing up, was really helping us understand the length of the letter of intents of those term sheets. How long do they last? I think CalHFA is trying to be a great partner and working with people. And as we all know, the markets are changing dramatically right now due to national legislation. So I think that does help us understand a little bit more.
Yes, and to that point, as the tax reform issue began heating up, we actually stopped issuing new letters of interest just due to that uncertainty and what we were really what our cost of capital was going to be. So that issue is kind of behind us, and the tax-exempt bond market hopefully will settle soon. And so I think we're at a point where we can reprice and issue new term sheets.
I can tell you on our closings that happened right after the election, so November of 2016, that none of our investors and lenders honored their letter of intents in their term sheets. And so so I think it's admirable, but I think a year might be long to be holding off on an update to the term sheet. But I don't know if anyone else has thoughts about that, or Eileen, you're...
So you're offering this, you're locking in the spread to Treasury? Are you
Yes.
doing that? Okay. And then within, I see you have a cushion in the assumed interest rates. You're underwriting it with a little bit of a cushion, but
Right.
we've had some pretty volatile swings here in the last year.
Yes.
So what happens when the markets move, 50, 80 basis points, and you had a 25 basis point cushion? What
Well,
happens?
Then, obviously, there would be a gap, and we'd have to work with the developer, the sponsor, to
Okay.
identify how they're going to fill that gap. And it wouldn't necessarily be that we would offer more concessions. It would, be more on them to come up with a plan to fill the gap.
So that, in terms of the loans we see before us, given where the, I mean, are you kind of looking at a current rates now when you're presenting the pro forma to us?
Where are we with on this project?
As you've mentioned, the rates have been so volatile, and the time periods between when we present these reports into the system and by the time they get to the board. On this one, there's been a 20-point move just in that time period. Fortunately, this one was underwritten at 475 with a margin. We reached the margin. I think we were at like 290 on the 10-year yesterday. You'd put 185, which was our spread on this, and we're at 475. So this is fairly accurate. On the refinance with equity out, it's not quite as critical because the equity out is the balance.
Okay.
So you just adjust the equity.
Yes.
So I move to approve.
Is there a second?
Second.
Any further conversation, questions?
Yeah, I have a question. It's not specific to this loan, but it's something that's mentioned in this loan, and I just
Oh, I
wasn't
had one
aware of
other
it.
too, I'm sorry, good.
It was just about the, reference the earthquake insurance for the CalHFA pool, and I was curious, are most of our loans or all of our loans insured for earthquake risk?
There are earthquake zones where we require insurance, and then we collect it. We've offered a pool that covers, it's available to anyone in our portfolio that is a discount from the normal market rates.
Okay. Thank you.
And I'm sorry, I got distracted when Stephen had another comment, which is on page 7 of the packet, page 2 of the report, under item 13. So it talks about CalHFA will relinquish the administration to HUD of the new Section 8 contract. And I don't know if there's any conversation we wanted to have about that, what that means as a policy for the organization, and is there a financial impact as a result of that?
Well, I would say that is not a voluntary on our part. It's a HUD decision. As contracts have been renewing for either a loan in our portfolio or where we are administering the HAP contract. We currently have about 87 of those projects in our portfolio, and HUD has made the decision over the last few years that as those contracts are up for renewal, they're taking them back in anticipation of rebidding and doing this national bid on
the PBCA.
On the PBCA. We have asked HUD more than once to reconsider that decision, at least on a year-to-year basis, because it makes economic sense if we're holding the loan for us to do the servicing of the Section 8 contract and doing the inspections, and it sort of makes governmental efficiency sense for us to retain those, but it's kind of fallen on deaf ears with HUD.
Okay.
Sorry to say.
Any other comments, questions?
I was just gonna add that, if the sponsor, I am aware, of a few nonprofit or faith-based organizations in Contra Costa who have the land and might be interested in possibly, collaborating with them, because they have the funding issues so that they have the land. So I'd be happy to forward those names to, them. And they're not in Lafayette, but they are in Contra Costa, so wasn't clear if they were planning to turn that money around just in the Lafayette community or would entertain going outside the city of Lafayette.
I'm sure they would welcome those opportunities. Thank you.
With that, let's take the vote. Roll
Okay,
call.
the motion on the floor is to approve Resolution 1803. Ms. Avila Farias?
Yes.
Mr. Schaefer?
Yes.
Ms. Gallagher?
Yes.
Ms. Gunn?
Yes.
Mr. Hunter?
Yes.
Ms. Amon?
Yes.
Mr. Prince?
Yes.
Ms. Von Cook-Liebert?
Yes.
Ms. Sotelo?
Yes.
Mr. Russell?
Aye.
And with that, the resolution 1803 is approved.
Thank you.
Thanks. And I don't think that this was part of the resolution, but I think we would love to hear more about the LOI and the letter of interest and the term sheets and rate setting and things like that at a future date, just to help us understand it better.
Yes, and I went to get, I left to get a little clarification on that. So our spreads are set, but the interest rate is not set until it's not locked until 30 days before the deal closes, is that correct?
Right.
Yes, so hopefully I think that would clear it up, but if not, we can
That'd be
talk
great.
offline. Thank you.
Thank you. I would like to bring up Sabrina Saxton, the loan officer on the Ramona Senior Apartments. And I want to point out on this
And
particular.
thank you to those of you who joined us. Thank you very much.
I wanted to point out on this particular project, we talked a moment ago about the Federal Financing Board bank funding ending for us in the near future. As a result of that, they've imposed some administrative deadlines for locking up funding under that program. And as we look through our pipeline, we're rejuggling who gets funded by what source. And so this project, assuming it gets approved today, we would propose to fund with the FFB program because it's farther along in the process and could meet the HUD deadlines. So that would be a change from where it says that the loan would be funded with CalHFA internal funds. It would continue to be a HUD risk share loan, but the source of funds would be the Federal Finance Bank. And with that, I'll turn it over to Sabrina.
Hi, thank you. So this project is Ramona Seniors Apartments. It is, click it to the next one, yeah. This is a new construction, perm takeout loan, 62 units of affordable housing in the city of Ramona, which is in central San Diego County. The entire project will be restricted to less than 50% AMI. And the project has a HAP contract, or will have a HAP contract for all 62 units from the county of San Diego. The site, as you can see here, it's about a half block away from Main Street in the city of Ramona. So it's close proximity to food, transportation, and other services. The new construction will be standard wood, two-story construction. It's one structure with the residential units sort of flanking. Actually, if you could do the site plan. Residential units flanking the central community building and community spaces. And the parking is going to be at grade surrounding it. So the 62 apartments are comprised of 52 bedroom units and 12 three bedroom units. No, I think I might have. Sorry. 51 bedroom and 12 two-bedroom units. The total development budget for this new construction project is about $23 million, which comes out to about $380,000 per unit. The developer is working on some cost reduction strategies. CalHFA's affordability restrictions on the property will be 13 units at 50% AMI, and then possibly an additional 19 units at 60% AMI, depending on the sources that we use. But the important part is the overall affordability restrictions on this property for 55 years are 8 units at 30%, 7 units at 35%, 7 units at 40%, 7 units at 45%, and the balance of 32 units at 50% AMI. The financial structure of the deal, it's a 9% deal. The developer, Chelsea Investment Corporation, has been awarded 9% credits, and the closing for that is coming right up in the next month. San Diego, the county of San Diego, is providing a soft loan in the amount of $1.8 million in addition to the rent subsidies that they're providing. AHP it has committed $610,000, and Wells Fargo intends to be the construction lender as well as the equity investor. So Chelsea has requested from CalHFA a permanent loan in the amount of $7,840,300, and that will be financed, as Michael mentioned, probably with FFB funds. It'll be a term of 40 years and an interest rate of the 10-year Treasury plus 2.5. The 10-year Treasury has gone up since this report was published, and the interest rate that we're looking at right now is about 5.4. So I'll be working with the developer to account for that change. The one unusual point of this project, the HAP contract provided by the county has a term of 15 years with renewals available at that time. I know the board has been discussing the transitional operating reserve. And normally with a 15-year contract, we would put a transitional operating reserve in place. For this project, we are requesting that not be required. We feel the project has some strengths that would exempt it from this requirement. Obviously, there's no equity out because it's new construction. The County of San Diego is heavily invested in the financial strength of this project between their soft loan and their subsidy funds, and they are likely to prioritize renewing the Section 8 contract. The HAP contract and the equity compliance period are both about 15 years, so if for some reason the contract cannot be renewed, there would be an opportunity for a refinance of the project or a restructuring. Chelsea Investment Corporation is a well-established developer, owner, property manager, and they have the internal capacity to deal with unforeseen circumstances. And since the financing of this project already requires soft financing, we just don't feel that it would be an appropriate use of funds to tie up for 15 years in a TOR these scarce subsidies. And if the TOR was required, it would require either additional soft financing, additional financing from us, and it doesn't seem necessary. So I welcome comments and discussion on that if you have any questions. In conclusion, this transaction will create 62 units of affordable restricted housing below 50% AMI for 55 years, and CalHFA staff feels that this is a great project for CalHFA to be involved in. Thank you.
Any questions, comments?
Yes, I have one. Sabrina, thank you for the presentation. You mentioned that there's a target for cost reduction strategies.
Mm-hmm.
Do we have an idea about what range, a certain percentage or dollar amount that the
Not
developer
yet.
is looking at?
That's something that we're sort of actively doing right now. So I not yet. But that will certainly be worked out in the next several weeks, probably in the next several days.
Thank you.
It's your community, Stephen.
Yeah, no, I'm just looking at, you talk about cost reductions there, because it actually seems like the actual cost is not that, we're talking about maybe 320 a square foot for construction
Yes.
costs. It's an inherently inexpensive form of construction. Where do you think you can squeeze more? And let me editorialize a little bit on that, because the second highest cost per unit is the local impact fees, and I think it speaks to the larger issue that we as a sector need to deal with, is we've loaded all these expenses on all of our housing production. And when I look at hard construction costs are number one, local impact fees are number two per unit cost. You can't negotiate those down. So where realistically do you think we can find savings? Maybe it's rhetorical, but.
I think at this point it's rhetorical, and that is something the developer is looking very closely at right now.
Okay. No, and I'll speak to the community. It is I think, very cost effective. This is an area outside the city, but it's actually part of the region's City of Villages strategy. So it's an area that's intended for urbanizing around, it is an ex-urban village, if you will, and this is part of fulfilling that strategy of developing the region. So the location, especially for seniors, is appropriate. I really don't have any other questions or comments.
Thank you.
Jonathan?
As per my background, the key thing I was looking at was the services package. And I have a high regard for serving seniors, but it struck me in the description, it said the services cost, which is a pretty rich package of services, would be covered in the operating costs, but they're not detailed out. So are they covered by the administrative expense? The operating and maintenance budget is only $55,000 a year, and that could not cover that services package. So it would just be really helpful to know where that services budget is and what they're really budgeting for, and the extent to which any of those services are actually covered by funding outside the project. It would then be important to know what those funding sources are and how secure they are over time and over the life of the project. So it struck me that this is a project that to be successful is dependent on that services package, and so I'd really like to see a better description of how it's funded and how it's, how sustainable it is.
Yeah, we have, the developer is here from Chelsea Investment. I'm going to invite him up here, and he can introduce himself.
This is Kurshat Mr. Leogla. I'm the Director of Project Finance. So, Jonathan, I think the services cost is accumulated in the administrative line in your analysis, Sabrina. And Serving Senior has a very unique business model. They are very cost effective in delivering those services. We do have $52,000 a year services budget for them to receive from the project cash flow, in addition to any other in-kind or subcontracted out services that they would provide to complete that committed services plan.
Yeah, so
We have done several deals with Serving Seniors.
right, so basically, $52,000 for the in essence, is in the operating cost to support the services. But when you look at that description of services, one supportive service manager, a service coordinator, supportive services director, a registered nurse, an activity coordinator, you can't buy that you couldn't buy one of those for $55,000. So I'm assuming it's portions of those positions, and it's just where that's an integral part of the project, I would really like to see that spelled out. And I'm assuming that probably they're using a lot of their other funding sources to support those, but also they're not full-time positions. I'm guessing they're fractions of position, because like I said, $52,000 certainly wouldn't cover a registered nurse.
Right. I mean, I think they do utilize cost allocation as you're explaining, and their budget and committed services to us. Right. So I don't think that 100% of the services cost would be paid from the project cash flow. So in a typical scenario, they do have several different funding sources. Right. So they do a cost allocation plan and accordingly provide such services.
Yeah. So I would just say, and this is not to the project so much. Like I said, I know Serving Seniors as an organization, and they're a great organization. I also know Chelsea. I would just say to the staff, when you're including services as a critical component of the project, I'd like to see a much better description. That's been my career, is funding services. So I would like to see a better description of what actually is being funded and how it's being funded. And it's particularly important to me when when a significant part of the services are being funded by sources outside of the project, to know what those sources are and how dependable they're going to be over the life of the project.
Thank you.
So I have 3 questions, if I can. One is with regard to the tax credit rate. It shows that it's over $1 in terms of the federal tax credits. I assume because you're closing in the next 90 days that is firm, not changing.
We have to close in the next roughly 30 days.
30 days.
And that's the committed amount. Since Wells Fargo is a one-stop shop, structure in this deal, so they can make the difference between, the construction loan interest rate and the timing, the pay-in schedule of that equity, since they are the same pocket. So they already did commit to $1.
Okay, great. And then,
And just, my experience with Wells is, A, when they want a project, they pay for it, and two, they're one of the ones who did not change their term sheets with the Fresno Housing Authority
That's
as
correct.
they did deals, and so Wells Fargo has been one of those that holds to what they said as they went to it. I don't know if anyone from Wells is here, I don't mean to give them a plug, but there's some confidence
well,
that I would.
They actually need a plug, so.
It's yeah, that's true. Some of the things happening with them, but yeah. So I mean, that's been our experience as well. But
Yeah.
because it does seem like a high number, but it's with Wells. So
So this question is more for staff. One of the things that, we talked about, and this is something that I do care about, is a transitional operating reserve. And so for us, because our loan is so significant, and because our loan is a 40-year loan and not just a 15-year loan, and because the way the federal perspective is right now around long-term contracts, there is, a concern around the volatility of that, even though our local partner here is certainly committed to the project and certainly committed to the renewal. But the reality is that the local partner doesn't have discretion as to whether or not it will renew beyond the 15-year period. So I just wanted to point out to the board, Section 13 of the report talks about the transitional operating reserve, and the amount would be $286,000. That for a project of $23 million is not a huge number. Right now, staff does point out that the operating expense reserve that we're holding equates to half of that amount. So instead of waiving our policy, what I would recommend and offer as a potential compromise is that we provide an opportunity for the developer and the limited partnership to deposit into a transitional reserve over the first 5 years of the project, so that by year 15, we can have something that actually looks like a transitional reserve. So we're not holding it completely upfront, and it's not coming out of development costs, but it's actually coming out from the robust cash flow that we have being generated on the project. Again, because of our permanent loan and the risk to our debt service, my concern is by waiving this requirement, we create a precedent moving forward.
well, and if I can make a couple of comments, and then love to hear your answer and your thoughts. But I also have concerns, even though it sounds like it's project-based vouchers from San Diego's county's baseline allocation, but the president's budget that was released earlier, earlier this week was a 16% cut in HUD budget, right? Congress last year received a similar proposal from the president and did not allocate at that level. They allocated a little bit more full funding, but how long is that going to happen? So I totally agree. And then the corollary, or the part of that, and you've already mentioned, I mean, a loan to value of 30% or so is a pretty high percentage. And so it does seem like a lot of risk without a transitional operating reserve. So with that, I agree with your concerns, and you have a really good idea as an answer. I'd love to.
Yeah, I think that maybe instead of negotiating that here in an open board meeting, that we not waive it, and then we direct staff to figure out a compromise of how to figure it out. And maybe, I think that Tia has the authority to go ahead and work out the details of that without changing our policy.
To the chair.
Yes.
That would be part of my question here, is that given the interest rate environment we're in right now, just exactly how much authority does the executive director have to implement? I'm inclined to be supportive of what Dalila is discussing here, but to what extent can that be delegated to the executive director, if at all?
I hope you're not asking me that.
I think that to the extent that we are not waiving policy, and that it is about implementing underwriting criteria and guidelines, I think that there is a lot of discretion within the executive director.
There is that discretion, but I want to know the dollar amount. So what dollar amount are we talking about? Because I want to make sure I'm not exceeding Are we talking about the
$286,000.
Yeah.
Yes, I have,
Yeah.
That's not accounted for in the budget.
go ahead, Sabrina.
So I think that we wanted to be, with this project, we all agree within CalHFA that that this waiving this policy would be acceptable. I think we wanted to be very forthright with the board because we know that it's an issue that is something that is of concern. So I think in that sense, we're not, we want to make sure that that's brought to the forefront. I will also add that the project has gotten to this point without the inclusion of the concept of a transition operating reserve. At the time when we were originally underwriting this and the initial approval occurred, that wasn't a policy that was definite yet. And so at this late stage in the project closing would be another reason that we would consider, honoring our initial commitments with the developer.
I think what the board member is suggesting, though, is in lieu of taking the operating reserve that you pay over a 5-year period into a fund for an operating reserve. So does that impact any of your underwriting numbers or jeopardize the project from closing? Should we look at funding over a 5-year period?
We can certainly look into that.
Just want to provide a couple of points as a feedback. I think you're referring to the residual cash flow after everything, right? To the extent we need to look at that, whether we could size a reasonable amount. And I think $286,000, not a material amount, but also at the same time a material amount for the project economics. If there is no renewal, I think the issue is going to become a bigger problem, not $286,000. However, though, we have not reflected the interest rate increase on the numbers yet, so there is going to be a material, almost 40 basis points in such a big loan, I think would make a material difference. And we will absorb that by deferring more fee. I agree with you. We're looking at some construction costs, but we're almost, it's pretty cost effective if you look at it in the big picture, how the construction costs are going up, the interest rates are going up, and the pricing is being adjusted. And Chelsea Investment Corporation is a very big balance sheet, and we are committed to guarantee any potential operating issues. One final point, since we do have home funds through County of San Diego in this deal, we do have a larger operating reserve amount, more higher than a typical amount in new constructions like this. So we are already we'll be accruing more cash for operating reserve. In addition to that, we're going to put our balance sheet behind it. But in combination of interest rate increase and adding a dollar per dollar, it's a 9% deal. You can increase your basis. So the 286 rounded up like $300,000 would be a dollar per dollar increase in the gap, in addition to the impact of the interest rate hike. So I guess from our point though, we would respectfully ask that, we are committed with our balance sheet. When the time comes, if there is an issue, I think the issue is going to be bigger than 286, and we will address that.
So, again, I didn't want to negotiate this at the table, right? So I wanted to leave it to staff to go through this. But, just to give staff a little bit more guidance, the investor is requiring a $321,000 reserve set aside. So they have already looked at it as an issue, and you should ask what that 321 is for. If it's for a transitional reserve, because, investors tend to do that, then that would satisfy our policy, in addition to the $93,000 that's budgeted in the project. So if that total $415,000 in capitalized reserves can be used for transitioning of, again, it's not the purpose of a transitional reserve is to not help, is to not financially impact your project. As a developer, you're going to have to resolve that issue in year 15 if your HAP contract doesn't get resolved. What it does is it protects the seniors that are living in your project from displacement, right? From complete displacement and the uptick of having to pay 30% of their income to then all of a sudden having to pay a rent that's at 50% of AMI. So this is about protection of tenants and not necessarily protection of developer interests and the financial. I'm a developer, so, you know, it's not that I don't like developers, I do. But this is about the protection for the tenants and the residents. So I would be satisfied that if staff did some homework on the $415,000 of reserves, and in future staff reports, if they could please identify when they're asking for a waiver of the transitional operating reserve, the other reserves that are in the project, and then maybe think a little bit more creatively about how to protect the interest of the seniors or the residents in year 15. I would be happy if you guys did that.
We'll definitely go back and have that conversation and take
Okay.
a look at those things.
Great.
And not to beat a dead horse, but you're bringing up the right issue. I mean, again, it's, the HAP contract is 15 years, but it's subject to annual appropriations, so it's going to be interesting kind of situation. And you've also made me, I don't think it's something to be solved right now, but I think it's a question that we should be asking, is that if HUD actually does increase its payments, tenant paid portion from 30% to 35%, what's going to be happening to the seniors within these properties? And so I think looking at the well-being of the residents is at the top of our list. It's not about real estate transactions, so I totally appreciate the questions you're asking. So, yes?
And also, I wanted to let the board know that during our policy retreat, we'll have a section on this policy, like talking about transitional operation reserves, talking about tenant displacement, talking about when we're talking about construction costs, new construction versus holding money in reserve, and how do we deal with some of those issues. So I plan to have a robust discussion and that be on the agenda.
Catherine, were you about to ask a question? Okay, I saw you moving your mic. Any other comments, questions? Is there a motion?
Move approval of 18-04.
Is there a second? So, any further comments, questions? Yes, Teresa?
Well, I have a question with the motion. Does that motion take into account Dalila's direction to go back and look at the operating reserve, or does that need to be in the motion?
Well, I think the motion itself, and maybe we need to talk to council about it, but the motion doesn't ask for necessarily a waiver of the policy. It's just the staff report that contemplates that. And so I think the direction that we're giving to staff is to approve the project and to look at the reserves so that we don't have to do the waiver of the policy itself.
And that was the intent of the maker of the motion.
Do we need council to?
Yeah, we need the council to take a look at the resolution and see how the resolution is drafted.
But I'm also, can I add, I'm comfortable with the language as I see in the resolution, that it does allow you to modify the terms and conditions of the loan. I quote, "As described by the staff report, provided major modifications are submitted to the board for approval." So I think within the purview, within the language of the measure, you are clearly working for us and will come back and report to us. So I feel comfortable that the approval and the direction provided through the discussion of the board is sufficient for the intended purpose.
Because you're,
Is that?
because to be clear, the motion would be to approve the resolution.
Correct.
Okay.
It's approving the
That's
resolution.
So do we feel like we are clear about what the motion is? And the second? I'm giving Teresa a second to read
I'm
it.
sorry, I'm just re-looking at the language here. So, and the language of the resolution appears to be pulling in the terms of the loan condition, and is not the waiver, the board doing a policy waiver, in essence, part of the terms of the loan. I'm not trying to be a stickler on this, I just want the motion to be clear. That's all.
So the terms, so you're talking about line item 636 of the resolution. Acceptable, subject to recommended terms and conditions set forth in the staff report. Oh, just a point of clarification, it does say, and any terms and conditions as the board has designated in the minutes of the board meeting. So
Okay,
I think this is
missed
going to
that
be
part.
reflected in the
All right.
minutes of the board meeting.
Then I'm good. Thank you.
Subject to council approval.
Right.
So I think we have clarification, we're comfortable?
So board wants us to have a transitional operating reserve on this particular deal, or to have a discussion about transition operating reserve.
So the direction we're giving to staff, if the board agrees, is that we take a look at the $415,000 reserve that exists, that's currently being required by the investor. And if that can be used as a transitional operating reserve, then we would not add an additional reserve on top of that.
But if it cannot,
Then you should report back to us.
and so does that mean this is a conditional approval? Because this is a 9% tax credit
With
deal
the
that needs to
closing in
close in
30
90 days.
Well, I heard closing in 30 days.
30 days.
I would like to modify the original motion then for the, this is going to be a point of order. So am I permitted to modify the motion at this point?
You can withdraw the motion.
Or I would just
Withdraw.
withdraw it? That's probably the easiest thing to do. Would the chair permit me to withdraw the motion and introduce a new motion?
So when I was parliamentarian for NARO, when this stuff came up, I would run out of the room, but as far as
I'm just about to do that, Mr. Chairman.
So I think I'm totally comfortable with you withdrawing and doing a new motion.
All right. Then I would like to withdraw the motion to adopt 1804 with the hair that we've put on it verbally here, and instead offer a motion to approve 1804 as presented by the staff with an understanding from the board that this matter of transitional operating reserves, particularly in the context of what's going on in Washington, D.C. and the disparate nature of the HAP contract and loan terms, be reviewed for potential policy changes to be brought back to the board at a future date. Is that satisfactory?
I think that the closing is looking at happening sooner than our next board meeting. So I think that maybe that they come back and report what happened. I think that we're talking about giving approval for this resolution
That's
with direction to look at this issue, and if it's resolved, and to help us, to report back to us the resolution.
Let me help out here, okay?
Please.
So I think we can just, I would propose, now that the motion is withdrawn, I would propose a motion to approve 1804. Is that what the motion is?
1806.
As is, as stands, with the waiver of the transitional operating reserve. I would like staff, as part of the commentary of the board, to reflect in the minutes that the board is asking staff to look at this specific project to see whether the transitional operating reserve can be utilized as originally contemplated and, as required by the investor, and just report back. It's just a question.
That was my intent.
Right. And that's it. And in the future, the other commentary I want the minutes to reflect is that this waiver, the transitional reserve, does not substitute the policy of the board itself and the intention of the policy. And should we revisit that, we'll do that more formally at a later date.
And I'll second that motion.
We have a motion and a second. Any further comments, questions? Hearing none, we'll move to roll call.
So I'm not clear, Chairman, where the motion was originated? Is it with Ms. Sotelo?
With me.
Delilah.
Yeah.
Delilah, I
Thank
think
you.
Jonathan
Just
withdrew hers.
Move
and-
approval for
Thank you.
1804.
Yes.
All right.
Thank you very much.
Thank you.
Well, we haven't voted yet. Hold on.
Ms. Avila Frias,
Yes.
Mr. Schaefer,
Yes.
Ms. Gallagher,
Yes.
Ms. Gunn,
Yes.
Mr. Hunter,
Yes.
Ms. Amon,
Yes.
Mr. Prince,
Yes.
Ms. Von Cook-Liebert,
Yes.
Ms. Sotelo,
Yes.
Mr. Russell.
Aye.
Resolution 1804 is approved.
Now you can say thank you.
Thank you.
Thank you.
You're welcome. We look forward to the groundbreaking and the open house.
Same here.
I always get in trouble with my board for board meetings going on much longer. I know that Mr. Gunning's going to come back and say, what happened? This meeting went really long because I wasn't there. Now we're going to be talking about
So next up is.
Arbor?
The Arbor Park Apartments, and I've got Ruth Vakili here to present. And I'll bring up the PowerPoint.
I think that's it. Okay. Good morning. Arbor Park Apartments is a family apartment project in San Jose on King Road. It's 75 units. This is a request for a permanent refinance loan. It's new to our portfolio. The project was built in 2001 and is located in a mature residential neighborhood in San Jose along King Road. The area consists mostly of single-family and multifamily residences with commercial uses along King and Mayberry. It's near a regional park and in walking distance to transit, which includes bus and light rail, and every level of shopping. The project, built in 2001, consists of 2 residential buildings and 1 community building. The developer is Mid-Penn Housing, and they plan to administer moderate rehab of about $22,000 a unit, and the rehab will consist of exterior paint, roof repairs, deck repairs, parking lot and landscaping upgrades. In the interiors, they're planning on new cabinets, countertops, flooring, and bath fans. The community building will also receive upgrades as needed, and primarily to service areas and after-school program areas. The project is located in San Jose in a very strong market. The average occupancy rate for market rate properties is 98.5% and 100% for affordable properties. Most of them have long waiting lists as well. The market rents in this area are $2,500 for a 1-bedroom, $2,800 for a 2-bedroom, and $3,350 for 3-bedroom units. So the subject's rents are from 23 to 50% of market rents. The project is 100% affordable, with the rents ranging from 30% AMI to 60%, and 20% of the units are affordable to tenants earning 40% AMI and below. The project is currently 100% leased up and has consistently maintained between 99 to 100% occupancy rate. We are requesting a loan of $7.5 million for a 40-year term, and the interest rate that is shown in the board report is 4.8%, which is based on the 10-year Treasury at the time, plus a 210 basis point spread. So today, actually as of yesterday afternoon, that rate would be 5.01% with the same spread, and that would support a loan of $7.3 million at a 115 debt coverage ratio. So the final rate and the final loan amount will be set upon rate lock. We do plan on locking the rate fairly soon, as the project is ready to close within the next 30 days. As a part of this transaction, the City of San Jose will extend their affordability restrictions for 10 years and reduce their interest rate from 5.75 to 4%. The city will require, as part of the restructuring transaction,
that the project's existing 7 units that are at 30% AMI be made available to the city's Transition in Place program, which is a program that provides rapid rehousing for people that are transitioning out of homelessness. The city refers tenants to the properties and the tenants receive rental assistance and case management and supportive services for a minimum of 1 year. The funds are provided by the city, and the city will determine after that first year whether the tenant is able to maintain employment and also pay the rent at the 30% AMI level. If the tenant is unable at that time, then the city will renew that tenant's assistance program. The potential for having 7 units within this program is that there may be some higher turnover rate for these 7 units. So as a result, CalHFA is planning on holding a $112,000 operating reserve for the life of the loan in case there is some risk to the occupancy levels. This transaction, it provides funding for the developer to pay off Boston Financial, the investor, and also it pays off Citibank loan of about $4.4 million. It also extends the affordability for another 10 years and enables the developer to rehab the property, which already is in good condition, but with these improvements will extend the useful life of the building. The developer is Mid-Penn Housing, who has over 45 years of experience in affordable housing development and management. They have 24 projects currently in our portfolio. The property manager is also Mid-Penn Housing. Are there any questions on this property?
Any questions, comments?
I had one question about relocation. So apparently it's going to be done, all work will be done during the day and people will be able to return at the end of the day?
Yes, that's true. It's minor rehab. So the tenants, when you're replacing flooring, cabinets, the work can be done while they're at work.
So, but these are family units, and so the impacts on children doing schoolwork, et cetera, do we have accommodations with the community room or other ways that we can be sure that their lives aren't disrupted during the construction period?
Yeah, that's a good question. There is space in the community room for this. There are after-school programs, and if tenants, some of the tenants in the unit remain at home during the day, then there's room for them to be in the community room. And with, though, the current occupancy at 100%, there will not be an available unit for that purpose.
So I guess just focusing on the tenants is what are things that can be done that we can, as the lender, make sure that, are there enhanced activities during these times or special care taken for those tenants who are displaced? I realize it may be just a matter of a few days, but it's impactful.
Well, we'll certainly talk to the developer about that. In fact, the project manager is here,
Okay.
so that is always something that we need to be mindful of.
Okay, thank you.
I just have one comment. I totally appreciate making units available for families for the rapid rehousing program. And I think one of the challenges we have throughout California is thinking about both rapid rehousing, but also exit strategies for people coming out of shelters. I just visited the 3 shelters in San Diego, and the focus really being about the permanent supportive housing, the placement of families. And so we need to be thinking about how to do that, to include that within development. So I think that that's just a part that I saw that I'm really happy to see. So I just wanted to point that out. Are there any other comments, questions? Seeing none, is there a motion for approval? I should have done that first.
I move to approve Resolution 1805.
I'll second.
Second. Hearing no other comments or questions, we'll do the roll call.
Ms. Davila Frias?
Yes.
Mr. Schaefer?
Yes.
Ms. Gallagher?
Yes.
Ms. Gunn?
Yes.
Mr. Hunter?
Yes.
Ms. Amon?
Yes.
Mr. Prince?
Yes.
Ms. Von Koch-Liebert?
Yes.
Ms. Sotelo? Mr. Russell?
Aye.
Resolution 1805 is approved.
Now we'll be talking about Whittier and Downey Southeast.
Yes. Okay, I'm also presenting Whittier and Downey, which is a new construction of a 71-unit family housing project in Los Angeles. This project is in East Los Angeles on a major thoroughfare consisting of commercial uses, single-family residences, and multifamily residences. It's a mixed-use project which has residential units and 2 ground floor level commercial spaces. There are 2 levels of parking, and it's a total of 4 levels of development. I'm sorry, I'm looking at the slides. I should never do that. That's why we have him moving them. The East Los Angeles rental market is very strong, with the average occupancy of 97% for market rate and 99.8% for affordable properties. The affordable housing projects surveyed in the market area had waiting lists with market rents of $1,468 for a 1-bedroom, $1,737 for a 2-bedroom unit, and $2,256 for a 3-bedroom unit. So the subjects' rents are 33 to 72% below market. The project, as I had mentioned, consists of 4 stories. It contains 34 1-bedrooms, 19 2s, and 18 3-bedroom units. The ground floor and subterranean parking provides 93 spaces total. And at this point, we're estimating that the residential use will allocate 60 parking spaces, commercial use will allocate 33 spaces. The building's going to also contain a community room, a kitchen, exercise facility, a common lounge and laundry rooms, computer rooms, management office spaces, and playgrounds in the open courtyard. All of the units will have carpeting, central air conditioning, all appliances, including a garbage disposal, microwave, and dishwasher. 8 of the units will be ADA accessible, and 4 will be designed for hearing and visually impaired. The project is also designed to be energy efficient with the LEED Gold certification, and the roof will have Energy Smart membrane, plantings drought resistant. So it's going to be an exemplary project. It also will house 35 units, which are special needs housing, and the tenants will be homeless or at risk of homeless with mental illnesses, qualifying under the SNHP program. These units are subsidized through the Los Angeles County Flexible Housing Subsidy Program, and it is a 15-year subsidy contract. The supportive services will be provided to all the residents and organized by Life Steps in partnership with the county, the county DMH, and the Department of Health Services. These services will include life skills, wellness education, social support, conflict resolution, housing retention, and youth services. So these services are meant to not only support the 35 tenants, but also services will be available to the general population. CalHFA is providing a permanent takeout loan of $6.5 million for a 40-year term, and the interest rate in the board report is 5.15% based on the 10-year Treasury plus 245 basis points. The interest rate today would be 5.28%, and the interest rate will be locked 30 days before closing. The project is set to close in the next 30 days or so. At that time, the rate will be locked and the permanent loan amount will be determined. If the rate is at the rate it was yesterday, that would size a loan of $6.4 million. Bank of America is providing the construction loan of $27 million at 3.43%, and they're also the tax credit investor, providing over $25 million in equity at $1.02 per credit. The County of Los Angeles CDC will provide a soft loan of $2.5 million, and DMH will provide the SNHP loan of $3,325,000 at 3%, 55 years. There's also an AHP loan of $700,000, and this project serves residents that are between the ranges of 30% AMI to 50% AMI, and will be 100% affordable. The borrower, the developer is Meta Housing Corporation. They've been in business since 1993, and 5 of their projects are successfully in the CalHFA portfolio. The project manager will be John Stewart Company, which has substantial management experience throughout California since 1978. The contractor is Westport Construction, and the architect is Gonzalez Goodale Architects. And with that, I'll conclude my presentation if there are any questions.
Eileen, please.
Kind of a random question, but just the mix of the special needs population and family housing, is that in the physical construction of it, is that segregated at all? Is it integrated?
It's integrated, and there are a mix of 1s, 2s, and 3s, and it's appropriate for the families that come in and actually reside in the property.
I'm sorry, Stevens first, sorry.
So would you consider this to be in a high opportunity or low opportunity area?
When this was mentioned earlier, I thought, oh my goodness, I didn't look that up, and I knew it would be asked, but I'm not clear. So that's a good thing to research.
Well, so the reason I ask the question, though, is that when we look at this project, which is, the actual cost is very expensive, the per unit cost, it's because it does so many extraordinary things for this community, the site remediation, the fact that we're doing really large bedroom units. I believe, visually I would call it a low opportunity area, but I don't know what the criteria actually, in terms of proximity, may be. But I just really want to underscore this is a great community investment. It is costly, but the benefits to this community are enormous over time. And so this is a place where housing is community development in a very real way, and I don't want that to be lost. Whether it's high or low opportunity, it is a costly thing to do, but it's the thing we must do, and the reason we exist is because the market absolutely won't take a site like that and house a single person there. So I do have a small technical question, which is the tax credit pricing. Was it $1.02?
Yes.
And how is that locked?
Yes, it is. Bank of America also has a history of when they make a commitment at the price, they do ask for it to close on time, but they also honor their commitment, and we've seen that over and over in the past several closings.
Okay. Well, I will say, again, I think it's an extraordinary project. The populations it's serving are critical. Notwithstanding the fact that it is expensive, we should look at that and understand why, but I would be very happy to move approval of the item.
Preston?
So, yes, I saw Lynn, and then we'll come over to you.
Okay. So one of the things that's been in the news quite a bit lately is the discussion of affordable housing in areas that are near highways or highly congested traffic, and the impact that that can have on the resident. And so I just want to maybe ask or just state the importance of, when you are on a busy road or looking at the map quite close to Highway 5, of ensuring that in the design elements, protections for air pollution and noise pollution are taken into consideration with these projects?
Indeed. An environmental report is always conducted as a part of the development, and the measures are included in the design to mitigate.
Great, thank you.
Oh, I'm sorry, Catherine, and then we'll come back around to Jonathan. Sorry.
Yeah, similarly to on a previous project, it looks like outside agencies, the local agencies are funding the supportive services. Is there any amount budgeted from the project resources, even like for the service coordinator or someone to coordinate services?
The county is providing, through the DMH and DHS sources, they are providing the services directly to the property. The property is not required to pay for those services. So it is they provide the personnel, the contracts, and the funding for support.
Okay. So they would provide coordination directly?
Yes.
Okay, thank you.
So before I go to you, Jonathan, I think there was a motion. Is there a second on that?
There's more questions.
I know, we'll come to more questions. We'll do,
Oh,
if
because-
there's a second, because there is a motion on the table.
Second.
Okay, Jonathan will second. Now we'll go to more questions before we get to the roll call. Jonathan, and then Dalila, I think you have some questions then? Okay.
Yeah, so, on this one, I'm pretty comfortable with the services commitment because I know those agencies that are involved. The one thing that I found intriguing, and I don't necessarily expect an answer here, but I would appreciate some feedback from staff if you could find out. I was very intrigued that part of the operating revenue is from assisted living board and care. And I would be interested to know exactly what the source of that funding is and whether or not it triggers any kind of licensing requirements for the operation of the units. And so I don't necessarily expect an answer right now, but I'd be interested in knowing the answer to those questions.
Is there someone here who can answer that? No?
I actually, I'd have to go back to the Excel version of the spreadsheet, but I actually think this cell is picking up an expense that should be placed elsewhere, but I will check on that.
So the way the DHS subsidy works in LA County is a little different from a HAB contract. It actually is 3 terms of 5-year terms, and it's renewable on a 5-year basis as opposed to a flat 15-year basis. And given that it's coming from the locality, there's not the volatility that we have at the HUD level, right? So the DHS subsidy is actually a nice subsidy to be able to count on a going forward basis. Although there hasn't necessarily been a commitment to extend, and I think they specifically call out that there's not a renewal extension clause within the DHS subsidy. But I do note that there is a transitional operating reserve, and I appreciate that is there for that purpose. So thank you to staff. And just to echo Stephen's comment, this is $551,000 per unit, $65,000 of which is just the acquisition of the land. So the rest is really in tons of cost. And to the credit of the developer, it's a $2 million developer fee, but they're deferring $600,000 of that developer fee. So I think that's really great and commendable. I guess my one area of concern would be just in terms of what seems to be, and I kind of left my question about the interest rate. My question about the interest rate was not how we set it, because I think it's very clear that we set the spread, but we don't lock the rate until 30 days before closing. And so I get that, and that's very clear, and I think it's very appropriate. But with these loans, I mean, they're basically a forward commitment, locked forward commitment today for something that we're not going to actually fund until 18 months from now. So how do we as a board, or how do we as an agency deal with the volatility of that? Because we are now basically, in essence, giving a forward commitment to a developer. I'm not saying we shouldn't, but how do we deal with that as an agency?
That is one of the things we have been discussing internally, ad nauseum. And so I think we had a 3-hour meeting on that just on Monday.
Okay.
And we will continue to have discussions on that. And it largely centers around pricing and how we're pricing our product, and looking forward to what our next product would be. We're looking at that on a daily basis.
Okay.
And so staff has ad nauseum. Every day we're meeting on that and talking about that.
So when at the board level we consider it and maybe consider the item just as discussion, we'd love to hear that part of that discussion as part of our policy retreat. And one of the things that might be helpful to us is that there are lenders that actually do forward commitments outside of HUD and DUS lenders. So maybe we need to look at some, like Bellwether, they do forward commitments. So it'd be interesting to see who else is doing forward commitments and how they're resolving or mitigating their risk. But other than that, it's great.
Yeah. I think if you go back to like slide 1, picture 1, slide 2, that is at the heart of what's happening here, right? This is taking what looks like a historically blighted block and really transforming it. So there are additional costs of the structured parking and of the commercial retail space and the site remediation. So all of that kind of adds cost, but it looks like the right thing to do, even at $550,000, which per unit, which kind of, I thought 380,000 for one-bedroom units was like a little shocking in Ramona. So I think it's all about doing that kind of public purpose of helping a neighborhood revitalize. So I think it's fantastic in that light. I did have questions about the units set aside for people with either hearing or sight loss. Is that I can't remember the exact term you used. So I'm kind of curious about how did that population be determined to be the population to target? And then the second thing would be, is there a school nearby? Is there something, a employment center nearby that's driving that? I'm just kind of curious. And then the second thing is like, what does it mean to do design that is respectful of that population?
Good questions. And the part that I can tackle is that this is a TCAC requirement. And so being 8 units that are ADA compliant, 4 of these units compliant with other disabilities, but as for design and how the tenants are selected, I would need to call in the developer, Taylor Rasmussen, and I think he can address that more
And then as you
clearly.
come forward, Meta Housing is really unique. Whittier and Second Southeast is not such a good name, just saying.
Yes.
So I'm
Point
hoping
taken.
it's going to have a better name down the road.
It's very functional.
My comment as well.
And I got staff who do that. They name it based upon the location because they're just into the transaction. But yes, so.
And that's it, yeah. So I'm Taylor Rasmussen. I'm the project manager on the deal. So as Ruth mentioned, these are TCAC requirements, the mobility units and the sensory units. And so 10% of the units at the project need to be adequate or set aside for mobility accommodations, and same thing, it's 4% for the sensory units. So what that looks like in the unit itself, maybe the entryway to a bathroom will accommodate a wheelchair, or there's a roll-in tub, or the counters in the kitchen are set lower. And same thing, different alarm systems where there might be a strobe light or a louder alarm for a blind individual. So these are TCAC minimums that we're meeting here.
Fair enough. What's your new name? Do you have one yet?
We'll have to discuss after.
Yes, Jonathan.
My understanding is that you have to put up a large donation to have naming.
Oh, yeah, exactly what it is. I didn't want naming rights. I just wanted a prettier name. So with that, there was a motion and a second. Are there any other comments or questions? Hearing none?
Ms. Avila Frias?
Yes.
Mr. Schaefer?
Yes.
Ms. Gallagher?
Yes.
Ms. Gunn?
Yes.
Mr. Hunter?
Yes.
Ms. Amon?
Yes.
Mr. Prince?
Yes.
Ms. Von Koch-Liebert?
Yes.
Ms. Sotelo?
Yes.
Mr. Russell?
Aye.
Resolution 1806 is approved.
Thank you.
Thank you.
So we are, sorry. Tia's not helping me anymore. That's all right. Now, I think we actually, we're discussing the use of home purchase assistance for non-first-time home buyers. And I believe we also have a guest speaker as part of this presentation. Tim, is this you? If you got coffee downstairs, the rest of us could use some. I'm joking.
Hi, if Ted is still here, if Ted could join me, it'd be great. I'll try to keep this short. As good morning, members of the board. As everyone knows, there's been a lot of effort to deal with the various disasters over the different geographic regions of the state last year. I know there are many members of this board, including Lynn and ACD, who have been involved in these efforts. So, and Ted has been our point person on attending some of these meetings as well. So I'm going to keep it short and then try to talk first about what is it that we're asking from the board. As the board knows, that our single-family lending program is a first-time homebuyer program. And this is primarily because the value that we bring to the table, which comes from a program we call My Home, is what's used by the borrower for down payment assistance. And this pot of money that we branded as My Home is used only for first-time home buyer only. So what we're asking from the board today is the ability to use My Home to serve first-time home buyers, yes, but also to serve non-first-time home buyers who have been impacted by the disaster. We do have a lot more work to do following this approval from the board to work on the policy of this particular program. For example, I believe not every single disaster that's declared by the governor affects single-family homeowners. So we need to think about things like that, and we need to think about the duration of the help that we would provide. So we have a lot more work to do in terms of creating the policy. And our goal, again, I'm just going to lay out some of the high-level things, and I think that the board we can entertain questions from the board. Our goal is to have a purchased loan program by the end of this fiscal year, so by 6/30 of 2018. And by that we mean that there are some people who are, for various reasons, not choosing to rebuild on the site where they lost their home, and they're choosing to purchase a home that's, say, in the same zip code or in a neighboring zip code. That's another thing we have to work through in our policy. So what we're saying is that we can accommodate someone who wants to buy a new home with the assistance that we provide in the single-family realm. And we're hoping that sometime before this calendar year ends, we can provide a refinance program. So we think that what we're trying to do is complementary to some of the efforts undertaken by the treasurer, for example, who is also doing great things in terms of funding some of the local community banks and to infuse some liquidity in that world. So we're doing what we can do, and what we're asking the board is the ability to expand the use of My Home so we could serve non-first-time home buyers for people who are impacted by the disaster. Ted is much more involved in attending some of these state-level stakeholder meetings, and I think likewise with Lynn. But if the board wants to talk about that, I would defer to the two of them.
Well, if I may, I'd love to just start by making a comment. Just want to thank the CalHFA team for the work that has gone into creating this policy option. Ted and Nick in particular have been really working very closely with the entire state on its emergency response. When this process started, it was very clear that this was an unprecedented emergency situation where the need far outstripped the available resources, and there was a clear call from the governor's office to really think and stretch on what our programs currently offer and what we could do to be able to help those who had been impacted by these natural disasters that we have experienced both in northern and then subsequently southern California. So I think that the solution that's being put forward is graceful, it's creative, and it really does help, bring to fold all the resources that the state has to offer. And so I just want to commend the team for their time spent with the stakeholders, on the road traveling, working with a very complicated, large, multi-agency group to be able to come up with this solution.
Is that a motion?
Yes.
Is there a second?
Yes.
All right, and additional questions, comments?
I just think it's a great idea. It's a really creative way of addressing the issue, so congratulations.
Did we lose our speaker from the commercial bank?
No, we also have a gentleman here from Home Street Bank who will talk about their offerings in terms of construction, which is something that we don't do. So if we can have the gentleman describe their program
Should
after.
we do that before we take
Yeah.
action?
Yes. It's a
Okay.
part of his comments. Yes.
Okay. So that's Mr. Connor?
Yes.
And you want to maybe just introduce yourself very quickly?
Yes, my name is Terry Connor. I'm with Home Street Bank. We're located, one of our locations is on the 10th floor in the building. And just want to thank everybody for having me in here to introduce Home Street. What I've heard in this meeting with the first time with CalHFA is the displacement of people, the concern to put them in a house, back in their home. And that's what I'm here, just to kind of present what Home Street's all about. We're all about the community. We're in 5 states on the West Coast, plus Hawaii. And I've been a builder for 23 years on the East Coast, moved here 15 years ago, and have been lending construction loans for the 15 years. That's my pet peeve. So it's in my blood. So just hearing everybody today, with all the fire victims that we've had last year, I just want to try to see what CalHFA and Home Street can work together to put these people back in their homes. I just returned from 2 meetings yesterday, and I'm finding out that insurance companies are getting caught up paying out, but there's a lot of times there's a shortfall, and sometimes there's an overpayment. So our program, it's hard to explain, but most banks will lend their loan to values either to cost or to future value. What Home Street's offering, and it's our policy, we do future value. So most of the homes that have been affected are going to be in your jumbo range. So the 2 people that I met, the 2 clients I met last night, each time I'm basically put them in the same position they were before the house was burnt. So they were very excited. From the other banks they talked to, they just couldn't do that. They had to come in with a shortfall. With going to future value, Home Street can basically put them in the same condition. The rates right now with construction our programs are one-time close, so we can lock them into a rate now. And one thing about Home Street, our construction rates are lower than the market rate. So we haven't moved yet. We're going to move because the rates have jumped up, but our construction financing is below the market right now. So I'm just here to, I've given out some paperwork that shows 2 different samples. If an insurance company is a shortfall of what they owe on their present mortgage, we can basically give them 0 cash to close, put them back in their house and financing it for them for a permanent loan. The other one I spoke to was there's a shortfall. So they're very concerned as who's going to take up the shortfall when we pay off their present lender. Well, going to future value has a lot of room for these clients to come in with 0 cash to close again. So I just wanted to introduce us to see how we can work together to put these people back in the homes. And I understand from what I'm hearing is you're getting a lot of phone calls that people don't know where to go. And we would like to be a source to take care of these displaced homeowners. And that's what I've heard all day, is putting people that are displaced into housing. And it's a major ordeal. And at this time, FEMA's almost done. I've got a couple of my registered builders that are relocating to that area in Napa. So we're gearing up for it, but anything we can do to help you or you all can help us, that's the main objective I'm here for.
Thank you very much. It sounds like your 3rd career is going to be socially responsible investing, maybe at a nonprofit. So it sounds like your heart is right there. So thank you very much.
Well, it was nice to hear everybody talk today. It's the first time I've ever been to one of these type of meetings with an agency like you, and I know that Home Street has been doing a lot of down payment assistance with you. I don't do those. My focus is construction. So it was just great to be here. I appreciate it.
we're really happy to have you here. So, any comments or questions for our guests?
I have a comment.
Please.
So, and thank you, Mr. Connor, for actually coming today. And so one of CalHFA's goals is to bring together public-public partnerships, public-private partnerships, and to facilitate some of those things. And so I wanted to have Mr. Connor come today to let us know how the public sector, how the private sector is stepping in. We've been having meetings with internal meetings and about what we can do as the public, but I did want Mr. Connor to come present about how the private sector is stepping in. And if there's a potential partnership on the back end where he's coming in with some of his non-jumbo loans and doing some construction and he wants to do some permanent takeout in our refi program, those may be potential ways in which we can work together. But I did, and I appreciate you coming today, and I believe there are other members of your organization that do partner with us as a preferred lender on our single-family side.
Yes.
So thank you, and thank you for coming in and telling us what you as the private sector are doing to step in and help in this disaster.
Okay, thank you.
Thank you. So, anything else? Then we have a motion and a second. Do a roll call?
Ms. Davila Frias?
Yes.
Mr. Schaefer?
Yes.
Ms. Gallagher?
Yes.
Ms. Gunn?
Yes.
Mr. Hunter?
Yes.
Ms. Amon?
Yes.
Mr. Prince?
Yes.
Ms. Von Koch-Liebert?
Yes.
Ms. Sotelo?
Yes.
Mr. Russell?
Aye.
Resolution 1807 is approved.
So,
Thank you.
thank you. You're welcome, Tim. Presentation on multifamily conduit issuance program and pipeline. Back to you, Michael.
Hello again. First of all, I apologize that an early version of the report got into your packet, and you have the correct version, I think, as a handout today. This is a report that is usually a routine report presented at each board meeting, not presented, but included in your package. We wanted to call it out specifically today because of the circumstances around tax-exempt financing and tax reform caused issues that will mean we're probably not going to hit the $300 million goal for the program that we had this year. At the end of the year, there was a flurry of new applications on an emergency basis in response to anticipated tax reform. So we had that bubble of applications. After tax reform passed, they all withdrew their applications, basically. We continue to have projects in the pipeline, projects that were developed and put together pre-tax reform, and so in the current environment of lower tax credit pricing, higher construction costs, and rising interest rates, some of those projects are going back to the drawing board, and as a result, our production for this year will drop. $250 million is probably the best case. It is likely that that number might slide below that. But having said that, we continue to have a healthy pipeline in that we opened up applications for the May SIDLAC round, received the applications this week, and we received 10 applications for over $160 million. So these are projects that were put together in light of the current situation, so we have a good anticipation that they'll be able to proceed. However, that the timeline for those will be well into next fiscal year. So I just wanted to call that out to the board. Since it's an unusual situation and not the normal monthly report on that program. Any questions?
That's what I get to say. Any questions?
Oh, sorry.
Any comments?
Just keep up the good work. Mike.
Yep, thank you. Yeah, it's a very ever-changing environment, so thank you.
Michael, before you step down, I just want to revisit, and I don't want to beat this up, but the transit operating reserve. So when you all put in the transit operating reserve, is it to assist the tenant or is it to assist the project?
Well, it's kind of both, in that the idea is it covers the difference in income, or the overhang that you might call it, between the Section 8 rents and the assisted regulated rent. So that gap, that difference in income would be used for the project to cover its expenses and debt service during a year. Presumably that gives the tenants a year to adjust to the new circumstances. It doesn't guarantee that they'll be able to afford the rent at the end of the year, but it does provide that transition.
So if the HAP contract is already on a TCAC regulated unit, and it's regulated to income limits at 30, 40, 50% AMI, that tenant would never pay more than that rent restriction or regulated unit would be, right?
That's correct.
So the HAP contract is the difference between not just what the tenant is paying, but what that rent restricted unit is paying and the market rate of that?
Yes.
So is there a potential that if the HAP contract actually goes away, that the tenant's rent actually wouldn't increase because it's a regulated unit?
They're probably not paying up to 30% AMI, that their tenant paid portion is probably lower. And so what would happen is the rent would go up.
To the rent
To the
regulated
right,
unit.
restricted rent
Okay, and so
level,
when
yeah.
you're calculating those tours, you're calculating it based on what?
The difference between what HUD is paying, the market rent, and the restricted rent level. So
But,
the
but that's, not- but, so your tours then could actually be bigger than what the potential tenant's difference would be.
Except that I may have this wrong, but in a tax credit project, the HAP contract doesn't pay market rate rent.
You're right.
They pay the difference if the unit is restricted at 50% and your income is 30%, it covers that difference.
You're correct.
Between 30 and
Yeah.
50, it doesn't pay market rate.
No, there's an exception that 9% credits allow for the collection of the FMR
Yes.
on
Oh.
HAP contract rents.
So,
So the differential, again, it's called a transitional operating reserve for the purposes of transitioning residents out of that, of a tenuous situation where they wouldn't be able to afford the rent. So it functions in two levels. Ideally, a developer should be leasing the unit to whatever AMI level that unit is targeted. So if it's a 50% AMI level, the tenant should be a 50% AMI household. And then above that, the overhang is the Section 8 rent that they can collect, which is the fair market compared to the 50% level rent.
Right.
And then that's what the transition reserve operates to. So you're sizing it based on the overhang. What Preston's talking about is oftentimes what's happening in a Section 8 environment is that even though the unit rent is set at 50% AMI, the tenants themselves are at 20% AMI or 30% AMI. So the differential between the FMR and the rent that's being collected is actually a lot greater.
but what I'm saying is that tenant would never be charged the FMR. The tenant's
no,
rent would
no.
be restricted at the regulated
Right.
rate.
Correct.
So
Right.
there's I think staff and the board, we need to get aligned. Because what you're sizing your tour to is the overhang. But what the board is concerned about, and correct me if I'm wrong, is the displacement of the tenant. So if a tenant's rent is going to increase, that's what you're concerned about.
Yes, because what happens is if the project could underwrite at 50% AMI rents, then it would underwrite at 50% AMI rents. And the overhang would be the overhang, and then you do a tranche A loan above, or a tranche A, tranche B loan. But more often than not, the project doesn't underwrite at 50% AMI rents. So the developer's really, in year 15, going to have to realign and move up the rents within the tax credit regulatory agreement, but still move up the rents to a place where they can, break even and pay their operating expenses. And so what ends up happening there is the threat of displacement to residents that, can't afford the new rent for the project.
I do think that this is a great topic for our retreat, right? I mean, because I know what we do is units at 30% of AMI serving chronically homeless individuals whose incomes are pretty much zero.
Right.
So the transitional operating reserve is in effect to protect the tenant. But you're totally also right that there's a part of the transitional operating reserve that's, you're saying protecting the developer at some
Yeah.
level, and they're the developer, pull up your big boy pants if something happens. But what we're also saying is we're the loan issuer, and we want to make sure the loan is also paid. And so
Right.
that's where it's kind of
And there's
protecting.
there's a
That's the
little,
third
and
part.
I hear
Yeah.
there's a bit of a disconnect that I need to get back with staff with, because I believe they may be sizing their tours different than what you're talking about. And so we need to continue to have that conversation, and we'll bring it back during the policy retreat.
Nope. I think that's it. No, I think that we're actually, I'm ready to move on to item, like, the reports are in the document, so unless there are comments or questions?
I just had one comment. We also, Tina and I also sit on the CalHFA MAC board, and I asked the staff to distribute this first report under item 8A so that folks could see the wonderful success of the Cal Home program as, as analyzed by a third party. And just really, it was a great presentation that talked about the economic activity between 2010 and 2016. And I just felt it was very robust information for us to have. And maybe we look at it as part of our retreat at some point.
Okay.
Yeah, I just noticed the time. Time flies when Preston chairs. Any other discussion of other board matters?
There were a couple of things that board members asked to report back on, and so I want to make sure that I have my list, because I was frantically trying to take notes, and Melissa, I sure hope you were taking notes too. But I have the tour discussion that we wanted to talk about. We had the Ramona project that we wanted to go back and look at the specific operating reserves and ask the investor what those operating reserves could be used for. We also had
The
Melissa,
renaming of Southeast, no, I'm joking.
Melissa, did you have anything else in your list? Because I had those two things, but I thought there was something else the board had asked
Yeah,
for.
I have several.
The social services.
The social services.
And specifically on the LA project, what that assisted living board and care revenue source is, and does it trigger any kind of licensing requirement?
So there were those four things. Okay.
All right, public testimony. Any discussion from the public? I have one more item, and that's for adjournment. Is there a motion to adjourn? Stephen, any second? Eileen's shaking her head yes. All in favor, say, vote by getting on your feet. That's what my board chair says.
Thank you, Mr. Pratt.
Oh.
Yes.
And I didn't realize it was so late, so I'm going to take off because I have a meeting I have to get to.
All right.
Thanks.